Is crypto arbitrage a real thing today? Yes, it is. Is it possible to do it today and profit from it? Once again, yes, it is. And by the end of this video, I will teach what crypto arbitrage is, even if you don't know anything about trading or crypto in general. Welcome to Bitcoin Academy. I am Bitcoin Professor, and I am here to teach you about world of cryptocurrencies. All videos we make on Bitcoin Academy are 100% beginner friendly. So even if you don't know anything about world of cryptocurrencies, don't worry, you are at the right place. So the least you can do is subscribe to the channel. World of crypto was never in better place than today, because for the first time in history, we have USA administration that is supporting crypto. And that is a huge thing. If you stick around until the end of this video, you will know things that are known by less than 1% of world population. So without any more small talk, let's get into what you will be able to learn today by dividing this video in 5 key topics. Topic number 1, what is arbitrage? Number 2, arbitrage in crypto. Number 3, types of arbitrage. Number 4, trading bots. Number 5, risks of arbitrage. And number 6, my personal advice. All right, let's start topic number 1 with some real-life example you can easily relate to. Imagine you are 18 years old and you wash windows of your neighbors for $20. Neighbors need their windows cleaned every 20 days, and you, as an 18-year-old, have all the time in the world to clean them. It is a win-win situation. Now let's go forward a few years. Now you are 24, and you have a serious job now, so you don't have so much free time anymore. But your neighbors still need their windows cleaned. You then go and ask neighbors if they are willing to pay $30 instead of $20 now. Since you were a trustworthy service provider for them for last 6 years, they accept the new price. Now you know a guy from 1 block away that is 18 years old. You ask him if he is willing to start doing a job of cleaning windows in your street for $20. Now he is making $20 per house, and you are making $10 per house. Neighbors are happy, and you are still making money from it without much work at all. You are just setting up that job and making money with very small amount of risk. Just think about it. What is the worst thing that could happen here? A guy cleaning windows can quit in middle of a job. Then you would need to do one of the 2 things. Either go and finish the job yourself and keep the profit, or refund your neighbors until you find a second guy to work. So if we break it down, you are buying a service for $20 and selling it for $30. This lets you make profit of $10. So we can say you are benefiting from window cleaning arbitrage service. And yes, that is exactly what arbitrage is, taking advantage of market differences at a given time. The whole point of arbitrage is to do a super quick trade and make profit. In this case, you were buying for $20 and selling for $30 in a matter of few hours. If you got that right and you subscribe to the channel, we can move to topic number 2, which is arbitrage in crypto. As our previous example already said, with cryptocurrencies, it works the same way, with slight differences. But the core principle stays the same. You want to buy crypto somewhere and sell it somewhere else at higher price. But first, difference will be time. You will be able to see in some examples we will show that unlike our windows cleaning example from topic number 1, this happens in matter of minutes instead of hours. And this one needs to be done strategically. By doing this, you are not buying and hoping that the price goes up by some percent. Price movement hardly even matters. Only important thing is price difference between place you are buying at and place you are selling at. Okay, but how is this even possible? Well, you see, world of cryptocurrencies is still pretty young, and between various crypto exchanges, there are different liquidity variances. And don't stress when you hear a new term like liquidity variance. As I promised, I will break it all down so everyone can understand it. If you don't know anything about crypto, I would suggest going to watch our 24-minute course for complete beginners after you finish watching this one. Link will be down in description. Okay, breaking down liquidity variance for a second. Imagine some currency is stacked in a pool, along with counter currency. So let's say in one pool, we have Bitcoin and US dollar together. Now, when people want to buy Bitcoin, they need to leave US dollars inside pool in order to take it, and vice versa. So every time someone buys Bitcoin, there is less Bitcoin in pool and more US dollars. By doing this, price of Bitcoin grows because pool wants to keep both Bitcoin and US dollar inside it in order to continue doing business. Because if the price didn't move after putting some amount of US dollars inside it, there would be no Bitcoin left and pool would go out of business. This is called law of price and demand, the oldest and most fair law of finance. Okay, now that this is clear, let's get back to topic. We said there are sometimes liquidity variances between different crypto exchanges. But why? Simply because different exchanges have different pools. Larger exchanges have larger pools, and smaller exchanges have smaller pools. So price can move faster on smaller ones and slower on bigger ones, because it takes less amount of US dollars to move the price in smaller pools. And that is where you come in. You simply spot the difference of a given currency in a given moment and take advantage of that, buying it lower in one exchange and selling it higher in other exchange. This is much less risky strategy than day trading, for example, where you would need to rely on predicting price movement. And if you want to know more about various crypto investing and trading strategies, make sure to check this video. Link will also be down in description. Many traders call arbitrage a risk-free trading strategy because you are first finding trade opportunity and then making a move that will benefit you in a matter of minutes. For example, you find a car that is selling for $10,000, and then you find a guy that is willing to pay $12,000 for it. You simply connect the two. There is little to no risk since you are not even buying the car. Okay, let's move on to some real examples by going through topic number 3, which is types of arbitrage in crypto. Okay, let's dive deep in some examples. First type of crypto arbitrage is known as simple or direct arbitrage. And as the name suggests, it is pretty simple and straightforward strategy. You are essentially buying on one exchange and selling it on another one. For example, I would buy Bitcoin on Binance exchange at the price of $80,000. Then I would transfer that amount of Bitcoins to my account at Coinbase exchange. I would then sell it on Coinbase because the current price is $80,010. This would make me a solid $10 profit for just a few minutes of actual work. Now you might be thinking, but I can buy a bunch of Bitcoins and multiply this profit. It is simple math. But this is the part where it gets a little bit tricky. This simple arbitrage method will only work for a short period of time until my buying moves the price inside prize pool and prices even out. You remember how liquidity pools work? Just understand that I can't do this for, let's say, 1,000 Bitcoins. It can only be done with few before liquidity pools from these two exchanges don't even out, because the same applies for the exchange we are selling to. Price will lower down the more we sell on it. Same way it goes up on exchange we are buying at. Now, in the world of cryptocurrencies, there is also one more thing you need to consider, which are fees. You see, each transaction for cryptocurrency costs money, and depending on many factors, that fee may differ. So since we used Bitcoin as example, you should know that fee for sending Bitcoin can sometimes be even $10 or $20 for a single transaction. Because Bitcoin is #1 cryptocurrency and network is super busy all the time, so same applies for transaction fees as it applies for price movement. The more people try to send transactions at one time, the higher the price for that transaction gets. And if you want to understand how Bitcoin works, check this video on our channel. Apart from transaction fees, there are also exchange fees. Each exchange has its own fees for trading and interacting with crypto on their platform. So you would also need to consider that factor. Okay, but why are we even talking about arbitrage anymore? It sounds impossible. Yes and no. You see, we use Bitcoin as example, but there are infinite amount of cryptocurrencies and exchanges out there with much lower fee costs. For example, Ripple or XRP is a cryptocurrency with super cheap transaction fees. Simple arbitrage works. You just need to find opportunity and factor all things, so it makes mathematical sense. Okay, moving on to second type of arbitrage, which is called triangular arbitrage. It is a bit more complicated than simple arbitrage is, but on the other hand, it works, and people make money with it every day. In order to explain this one, I need to teach you how to start thinking outside of fiat currencies like US dollar. By now, I was using cryptocurrency examples like Bitcoin, and I was comparing its price with US dollar. But now we need to dive in further. Instead of looking at currency price in US dollar value, we will compare it between two cryptocurrencies and US dollar, making a triangle shape. And that is why this is called triangle arbitrage. So for this case, we will use a pair of Ethereum and Solana coins. So basically, you would go on and buy Ethereum for US dollar, then buy Solana with that Ethereum, and then sell Solana for US dollar, therefore closing the triangle. Okay, but how are we actually making money by doing this? You see, as I said, it is a bit more tricky than previous one, especially if you are new to trading crypto. But same way as simple arbitrage, you are making money from price differences somewhere in between. But instead of finding price differences for one asset, you are looking for price difference between 3 assets. So in this particular case, you find opportunity where you can get more Solana coins by buying it with Ethereum, then by buying it direct with US dollar. So there are two pairs that have current difference you can benefit from. So let's set this example so you can understand better. On the left side, you see Solana and Ethereum price in US dollar value, which is, let's say, $200 for Solana and $2,000 for Ethereum. And on the right side, you can see Solana price in ETH value, which is 0.095 Ethereum. Let's imagine you go inside this trade with $2,000. You would first buy Ethereum, which would get you a total of 1 Ethereum. Then you would buy Solana with that Ethereum at exchange rate I told earlier of 0.095 Ethereum per Solana, which would give you 10.53 Solana. And lastly, you finish trade by selling your Solana back to US dollar at $200 price, which would give you $2,106. So your profit is $106. And same as simple arbitrage, you need to consider fees for exchanging these assets. And you won't be able to do this infinitely, because every action would change the price until it evens out. Because unlike traditional finance, where governments can print infinite amount of money, creating inflation and manipulating price, serious cryptocurrencies don't allow such features. So same as before, you can make money on a small margin in small amount of time until price evens out. Moving on to topic number 4, which is trading bots. Okay, since we confirmed that arbitrage trading in crypto is a profitable way to make money, it is safe to assume that there will be competition in doing so. And there absolutely is. Serious arbitrage traders are developing bots that fetch data from the internet and alarm traders when certain price difference criteria are met. Since speed is the key factor in doing arbitrage, instead of relying on human eye, focus, and speed, it is much better to have computing power doing this. How do you get these bots? To be honest, the chance of you obtaining one is really low. Developers are being paid millions of dollars every day to create these bots. Competition in this market is way too high for a new person with little to no knowledge and resources to get into. People that are inside this kind of business are millionaires or even billionaires, and the average person can't hope to compete with that. It would be similar to going on a car race with your Toyota Yaris and competing against Lamborghini cars. Your chance is basically non-existent. Apart from bots that fetch data regarding prices, there are also bots that perform trades at lightning speed, which are even more complex than the previous bots. They get the info about the price, and if criteria are met, they perform the exchange themselves without the user needing to do anything. Sounds like a dream, but just know that if you ever reach a point of doing this, you have already reached financial freedom. And the truth is that the more money you have, the easier it gets to make more money. This example proves it. Another problem with trading bots is the insane development of technology. With AI blooming every single day, new and better solutions to technical problems are being invented, making it even harder to stay relevant in this line of trading. It is a rich game, without a doubt. There are websites where you can subscribe to find arbitrage opportunities for you. But once again, saturation is super high, and they can't compete with the development of bots. So I wouldn't recommend trying them. But does this mean doing arbitrage trading is impossible? Absolutely not. People have been doing arbitrage for years. In fact, before crypto was even invented, people were doing it with other assets. The same core principles apply to the stock market, and even with traditional currencies. Every day, people are exchanging US dollars for euros, British pounds, and so on all across the world. Because there are price differences all around the world, and we live in the digital era, where that information is pretty easy to find and execute trades from your bedroom. Getting back to crypto, there are a ton of small crypto exchanges that are not on the radar of these bots. And the only competition there are humans. People just like you. This makes it more user-friendly for beginners and people with limited resources. As we said, smaller exchanges have smaller liquidity pools, making it more realistic to spot price differences. And competition is not that high if you compare it to the top 10 or 20 exchanges. So, if you are looking to do arbitrage trading, this is the way you should approach it. But take note, like any line of business, it takes time and dedication. You need as much knowledge about it before diving in if you want to be successful. Understanding crypto in general, fee costs, operation costs, and so on will give you the advantage over others. That is the only way you can be successful in doing it. Any form of market trading is pretty simple and straightforward. In order for you to make money, you need to stay ahead of others. Okay, moving on to topic number 5, which is the risks of arbitrage trading. On paper, crypto arbitrage sounds great. You sit by your computer, find an opportunity, execute the trade, and take profit. But the truth is that there are many risks involved in this strategy, which make it harder to do. Let's divide them into 3 chapters. Chapter number 1, scams. As we said in the beginning, crypto is still very young. Because of that, many things still lack regulation. This fact gives hackers and scammers more space to operate fraudulently. Gaining knowledge is the only way to protect yourself. Scammers can create fake exchanges that look exactly the same as legit ones, with maybe only a different domain name. If you don't know what to look for, you may deposit your funds and lose them immediately, because in crypto, once a transaction is done, there is no refund. No one can reverse or stop your transactions. Scammers can also target you through email and social media, presenting themselves as authorities from exchanges, for example. They get you to click on a link, and in a matter of minutes, they steal your funds and data. So how to avoid being scammed? You always need to go only through official sources when interacting with crypto. For example, if you want to go to the Binance exchange, one of the safest ways would be to go on Twitter. Find the official Binance account, confirm that it is the real account by looking at the follower count, engagement on the page, and the checkmark. After that, you click on the link on their page, which will take you to their website. This way, you avoid any possibility of being potentially scammed. Chapter number 2, small exchanges. We mentioned earlier that the best arbitrage trading chances for regular people are in small exchanges. And that is true, but there is also a downside to this. You see, small exchanges have small liquidity pools, which lets prices fluctuate more, but it also holds more risks. Price changes can happen drastically in a matter of minutes if developers didn't do a proper job in the back end. You must understand that smaller exchanges have smaller budgets for development and maintenance than top ones. These problems can end in exchange bankruptcy. Glitches can happen, resulting in freezing or losing your funds. So you would need knowledge to distinguish between a small exchange that is reliable and one that isn't. Chapter 3, volatility. Crypto can be incredibly volatile, meaning prices can change dramatically, sometimes by more than 30% in a matter of seconds. In order to do this, you want to target smaller cryptocurrencies because there is a higher chance to spot price differences. But like smaller liquidity pools, it is the same with smaller currencies. They can change price much faster because less money is needed to move the price. So while performing an arbitrage trade, you might end up in the middle of a trade, looking at a chart with a huge price movement. This would result in you losing not only your profit, but also a portion of your funds. Because price difference won't matter anymore, in case your currency lost more value than that difference would have earned you. Okay, moving on to the final topic of the day, which is my personal take on arbitrage trading in crypto. Now, when we take all the factors we discussed today, we can make a few conclusions. First, yes, arbitrage trading is real, and yes, it can be profitable. In fact, I can say this with certainty because I personally know people who are doing it. But on the other hand, it is not so much beginner-friendly. There are many obstacles that make this harder than it seems at first glance, especially for beginners. So, the second conclusion would be that I wouldn't recommend getting into it if you're not ready to invest time and effort in it. It would take you time, discipline, and stoic emotional stability in order to conquer this type of trading method. Do I personally like this strategy? No, I don't. And let me explain why. You see, this method requires constant updating, meaning you need to be present most of the time, therefore making you work for your money. I prefer methods where you let money work for you. There are many better investing and trading solutions that don't require this level of dedication, knowledge, and number one factor for me, time. There is an old saying that says, poor people work for money while investing time in return. Rich people invest money in order to buy time. In my opinion, time is the most valuable asset each of us has, and I want to have it as much as possible. So, strategies like DCA, dollar cost averaging, are something that I prefer over arbitrage trading. And don't get me wrong, I'm not saying DCA is more profitable, but it doesn't require so much time or knowledge to achieve success. If you are interested in knowing more about investing and trading strategies I prefer, make sure to check our video where I explain 5 simple investing strategies and give a deep dive opinion on each one. To make a conclusion, I would say that there isn't any right or wrong answer about it. It simply comes down to what each one of you prefers. Okay, we have come to the end of this video. I hope you found it helpful and you did manage to learn something valuable from it today. If you did, please make sure to subscribe and leave a like. Also, feel free to leave a comment on which topic you'd like us to make our next video about.